Hello, everyone. We are going to get started today. Thank you for joining. Looks like a couple of people are still logging in, but I'm sure they will catch up quickly. Thank you for joining. We always are committed to getting you the most important information, updated information, and best practices to you, and so that you can run your company the most efficient. Today's topic is tax considerations for foreign businesses selling into the U.S. How's everyone doing today? Hopefully you have your lunch, you're ready to go, and we're going to jump right into it. So today's presentation is going to be split a little bit. The first half is going to be a little bit more on doing business in the U.S., more from a corporate and corporate tax standpoint, and then the second half we're going to get into selling goods into the U.S. if you have physical presence here or not, and what that means, and what it means of filing taxes in the various states. So that is what we're going to cover for you today. I'm Carolyn Powell. I am the Director of Business Development here and your host for today. We will do a little bit of housekeeping to get started. On the right-hand side of your toolbar should be your menu. There is a question section. Feel free to open that up. Shoot us a note if you have any questions, that aha moment, if there's something specific you're looking for today and hoping to get an answer on, shoot it in the Q&A. Also, there is the handout section. Go in there. You can get a copy of today's slides, bios of our presenters, and one of our other cross-border pieces. So feel free to go in and grab that. After the webinar today, you will receive a survey immediately. If you could send that to, fill that out, send it back to us. Let us know if you had any questions, if you want to set up a time to talk to David or Tom, and if you have any suggestions for future topics or anything like that. Let us know how we did. And then lastly, this afternoon, I will send you out an email directly with a link to the presentation recording and also the handout. So if you want to go back and listen to it again or share it with a colleague, you'll be able to do that. So you'll get that from me this afternoon. So hopefully everybody will engage and we'll get started. So our presenters today are David Lever and Tom Mazurek. David is a partner here at the firm and a CPA. He heads up our cross-border team and has over 17 years of work in public accounting. So majority of his clients are cross-border, but we do have several clients that are international doing business in the US. And then Tom is also a CPA and partner here at the firm. He has over 25 years experience in public accounting, and he is in the tax department and also the state and local tax. So he's gonna, again, focus a little bit more on when you start selling into the various states, what that means and what you need to do. So before I hand it over to our experts, we're gonna do a quick poll for everybody. Just launched it here. And our first question is, what percentage of your total sales are in the US? If you want to start filling that out, as those start coming in. Looks like we kind of have a mixed group here, but most of them 0 to 25% and up to 50%. A couple people aren't sure about it. All right, looks like most everybody got that in. We're going to close that. This will just help our presenters be able to talk to the group and just sharing the results with you so you know who's on here with you. And then I'm going to do one more. Bear with me in technology. And do you currently file taxes in the US on those sales? So just click if you want to let us know that. Kind of a mixed group here. Some people aren't filing, and that might be okay based on your level of sales. So it looks about half the group is not currently filing. I'll share that with you just so everybody can see who's on here. And again, David and Tom will address us, and I'm going to hand it over to David to get us started.
Thank you, Carolyn, and good afternoon, everybody. Thanks for taking a little time out of your afternoon to spend with us. I'm sure you can imagine over the last month or so in particular, there's been a lot of information in the news with the various proposals for tariffs on and off, and the whole kind of drama we've had regarding the border situation at the northern border, particularly, and the southern border, but particularly with northern border here. So we're going to go through. We don't practice in the customs duties, tariffs, particular tax area, but because of the situation and the proposals, we've noticed that there's been a lot of contingency planning happening with many of our clients that are Canadian, are mostly Canadian businesses, trying to sketch out what the impact is of those potential tariffs, and then to do some planning, especially in cases where those companies have a significant amount of sales into the U.S. So hopefully overall, I know we have a 1-month reprieve and a pause on some of those proposals, although I know the steel one sounds like it might be going forward. Hopefully cooler heads will prevail, and we'll get back to the great relationship that our two countries have with regards to trade. So we're going to go through a couple of different scenarios, I guess, today with regard to expanding internationally to the U.S. There's really 3 ways that most companies can do this. We're going to touch on 2 of those in particular in detail today. So the first is testing the waters, operating as the U.S. branch. So this might be a situation if your business is new to the U.S. and you just want to kind of dip your toe in here. You may have a project or 2 that you may want to embark on here. You're not sure that you want to fully commit to a physical location in the U.S., but you can. I always think of it as operating as a division of your business, having a separate U.S. division. Let's say that would be the branch model. So we'll talk about that. And then we'll talk about if you want to take that a step further and create a U.S.-based subsidiary entity and what is entailed with that, and some of the things you should be thinking about there. And then the third would be to acquire an existing U.S.-based business. We could probably have a whole separate webinar on that. And in fact, we have in the past. So we do have a link there in the slides, which I know will be shared today as well, with a recording of that webinar. And that information is a little bit different from what we're going to touch on today. So that information is available to you as well. Before we head into it, I think if you take nothing else out from our presentation today, these last 2 bullet points on this slide are really important. Best practices for your business if you're not already selling to the U.S. Or even really if you are, again, would be to develop that business export plan. There are a lot of resources out there available to you in Canada, particularly to help do that. Really just to map out where are the goods going, how are they crossing over, who's doing what, is there being value adding on the U.S. side, are there employees coming over, just taking all those different variables that we have when we're talking about these types of situations, and really putting the pen to paper and figure out exactly how that would look, because a few changes here or there with certain details can change your tax answers and potentially what we might come to as a plan for your business. And then the second being getting local professional advice. And while most of our companies that I work with is inbound to the U.S., I do have some that are outbound. And no matter the situation, it's important to have your trusted advisors on both sides of the border. In this case, of course, being mostly Canada and the U.S. But there's so much in the tax world that is specific and local that you really have to be aware of those things. And great planning ideas and advice in the U.S. only goes so far. And if it's not if it's detrimental to you in Canada or vice versa, then we really want to look at that global picture for you. So having those advisors on both sides, legal, probably, and accounting, are very important. So we're first talking about operating the branch in the U.S. We're always talking about the concept for a foreign business selling to the U.S. of effectively connected income. So that could be, what we call operating U.S. trade or business. That could be you sending your employees down here. That could be you selling product down here, which is probably more common, into the U.S. With the title passing here. That'd be a U.S.-sized transaction under statutory IRS rules in the conduct of the trade or business. So the next thing we would do then would be looking to the U.S.-Canada tax treaty to decide whether you are operating a permanent establishment, which is a fixed place of business under the treaty. And so if the treaty can then be used to override the U.S. statutory rules and provide some protection for you. So fortunately, up until the last few months or so, with our countries having such a good trading relationship, we have a pretty robust tax treaty. The U.S. has many tax treaties with countries, but Canada provides us probably with the most details and ability to provide some protections for Canadian businesses. So the PE, or we're going to have a few slides on this, is a fixed place of business. You think of it traditionally as your branch, your place of office. Fortunately, under the treaty as well, there are special carve-outs for building and construction sites, installation projects. So if you're in that type of business and you may come to the U.S. for a short period of time and then come back a few months later, we can look at the entire project from the time that you first set foot in the U.S. for that project to the time that project ends. And if it's less than 12 months, you would not have a permanent establishment. Second bullet point here about dependent agency and the ability to sign and execute contracts. So that one's probably a little more antiquated when you think about the way that business is transacted these days. We do see this a lot more with sole proprietors or businesses that really are one or two people type of businesses. If that business owner emigrates to the U.S. or is here a lot personally, it's very unlikely that they are waiting until they get back to Canadian soil to execute a contract or buying the company. So if you're doing that here, that is creating a permanent establishment for your business, and that can look a lot of different ways and could cause you to have to pay some U.S. taxes or file a U.S. tax return. But typically, that's something we can plan around. Providing services in the U.S. 183 days. So this is specific again in a 12-month period. I'm not going to get a lot into today, but individual taxes. There is an individual component to this as well about your workers that might be coming over here that is inherently tied to the status of your business relating to permanent establishment. But if your business is sending somebody here for 183 days or more during the year in that 12-month period, and 50% of the business revenues are derived from services here, like your predominant businesses here, you could be creating that permanent establishment for your business. And so that, it's very important to be able to track your days in the U.S. that you're sending your employees here. One day for the business, could be a day that you're sending 20 employees or one employee. But if you're sending 20 employees here on 20 different days, that is 20 different days for the business. So each day that the business is sending somebody here would be one day. The PE does not include, I'm not going to go through each of these bullet points here, but basically inventory. So if you have inventory in a 3PL situation, you have inventory on consignment. Tom's going to talk about the state and local aspects of that later on because they are different. But under the treaty, just purely having your inventory here does not create that fixed place of business for your business. And so what do we do? We have there's a couple different mechanisms here. If you're conducting that trade or business, but you don't have a PE, that's great, but there's still something for you to do. And that is to file a treaty-based tax return. So this would involve getting a U.S. tax number for your business, yes, you'd be on the radar of the IRS, would not have necessarily an annual obligation to file, only when you're transacting or having that effectively connected income with the US. And so we would file this treaty-based tax return every year with the IRS that you were selling into the US to say, hey, IRS, I'm selling into the US. I'm sending people down here for less than 183 days. I'm working on a construction site for less than 12 months, any of those things. We're covered in the tax treaty, and we would cite the chapter and verse of that, and file a treaty-based position. By IRS, you cannot tax us. We'd have to disclose, we don't have to disclose all the financial results of your business. We do have to disclose the amount of sales that you're making into the US, but it's purely an informational filing. The good thing about it is it starts with statute of limitations here, which is 3 years. So if your activity was ever in question, the IRS wanted to question you, they could only go back 3 years and look at things. There was an interesting court case a number of years ago now, Adams versus the commissioner, where Adams was a vessel company off the coast of the Gulf, and the company did not file a treaty-based tax return. The IRS eventually, the company ended up on the radar, and long story short, the IRS thought that they did have a permanent establishment, and because they had not filed a tax return, at least that treaty-based tax return, had claimed nothing in the past, the IRS assessed tax based upon the revenues of the business related to that activity, did not allow any expenses. So they went all the way up to the courts, and the IRS won that. So you know, it's a belt and suspenders approach. It might seem like a compliance nuisance, but finally that treaty-based tax return really provides you with protection, both short-term and long-term for your business. Now, if your company is operating a permanent establishment, not the end of the world. Again, I think of it as a division. We file a corporate tax return for your business called a branch return. We report all of your effectively connected income with the activity, so your U.S. revenues and related expenses along with that. We may be able to make some allocations of expenses from Canada, from your Canadian company as well, or at least from the home office. And then you would pay U.S. corporate tax at 21%, which is our current rate. One thing to watch out for there as well is, you know, the U.S. tax system, very much like Canada, has 2 layers of tax. So we have this concept called the branch profits tax. So that's the second layer of tax on the business, which is like a deemed dividend. So to the extent that your business does not reinvest the profits it makes in the U.S. into the U.S. Or into the activity to do more business here, then it's deemed that you brought those profits home. So under the U.S.-Canada tax treaty, you would pay a 5% branch profits tax, again, a dividend equivalent that you know, would be just kind of a cost of doing business. Under the U.S.-Canada tax treaty, also we have a nice lifetime exemption for your business of $500,000. That's in Canadian dollars. So the first $500,000 of profits that you generate here in the U.S. is able to avoid that 5% branch profits tax. And so that's another reason why, you know, you might consider using a branch to, again, test your business out here, test your business model out, a product, a project, something to that effect that would allow you to do that on a kind of a risk-free basis. There's some other federal tax issues, and we're going to touch on some of these as well, but just things to think about. Again, should you be creating a U.S. business entity? We'll talk about that next, based on your sales and activities. Where are you in your business life cycle? You know, a lot of the businesses that we tend to work with are mature Canadian businesses that have been around for a very long time, and they are now trying to, you know, penetrate the U.S. market. So, you know, depending on what that looks like for your specific business, we'll talk about that. You know, you may find that you need a U.S. business entity. Others are on, you know, on the other end of the spectrum, and they're more in a startup phase, and so they may be more willing to, you know, try to operate as that branch. And again, some of that's going to come down to the fiscal presence. But you know, if we do have U.S.-based subsidiaries, how we're going to structure that, what profits will be repatriated to Canada. And again, I mentioned it here for purposes of the slides, and I mentioned it earlier. Will my Canadian employees be subject to U.S. tax? Again, we're not going to get into a lot, but in many of the situations, if you're expanding to the US, there's certain know-how in Canada that IP type of things that may not be easily translatable to the US. You might not be able to find people specifically with a specific skill set. And even if you are, they still have to be trained up. So you may be sending people here to the US for a short period of time, whether it be a few months, 6 months, a year, something that to that effect. But we do have to look after, what that means. Is your Canadian business deemed to be doing business in the US by sending those people down here? Because we would look at, the Canadian business and the US business as two separate business entities. So moving on to the second way of doing business, that would be forming a US entity. So there's a lot of different reasons why you might decide to form an entity here. Typically, I would say if you know you're going to have a physical presence here, your traditional brick and mortar, outside of inventory, then that usually is a reason why we would probably gravitate right away towards forming a US subsidiary, but there might be others as well. You might do it for branding. You might do it for liability purposes. If you have a new product, or the US tends to be a little more litigious society than Canada does. So you may want to pen off your legal liability by separating that activity. Financing, of course, can be one, and tax planning, right? So we're going to talk about it. You have the ability to manage your US tax base, and in Canada, there may be some disadvantages to you operating and having foreign sourced income in your Canadian business. You lose some tax benefits. I know there's some capital gains treatments as well that can get skewed if you have a large source of foreign sourced income. So we're going to talk about a couple different types of entities that you can form. LLCs, we see this quite a bit. And oftentimes in these situations, we are a little bit late to the party. We haven't been engaged yet. LLCs are very easy to form. A lot of people can go right online and we can probably do it in 15, 20 minutes. There's not a lot of corporate governance, let's say, to forming those LLCs. Unfortunately, because of the nature of LLCs in the US, which are hybrid entities, they don't get tax-free benefits. So they don't. If you're operating in Canada through an LLC, you wouldn't get tax-free benefits. In the US, LLCs, if they're are sole proprietorships, if single-owned by default, or partnerships, if there are multiple members. In either of those situations, you can elect to be taxed as a corporation. But LLCs in Canada are viewed as corporations. So without looking after it, you can end up in a double tax situation where you may think that you have one layer of tax here in the US, but then Canada is going to impose a tax when you start pulling profits out of the business. So typically we would stray away from, the LLC structure. So we tend to, there's ways we can rectify that situation. Hopefully we can catch it early enough. Otherwise we may decide to possibly even abandon the legal structure and start over fresh. So limited partnerships are less common. We see them more in real estate. They do have some flexibility in terms of operations and management. You do have to have a general partner to that as well, which tends to be, most of the structures I've seen anyway, a US corporate entity, which would also be owned by you, but it would be the general partner. And so, there are still some considerations here. You have to have tax filings. It's a little bit more complex structure. You have to have tax filings for your non-resident owners. So the owners may need to file either, a personal non-resident tax return. They may have to file if it's a corporate owner, they may have to file that 1120F. They would still be considered to be operating a trade or business. There are less repatriation strategies available because we are going to flow through the income in a typical partnership as it's earned, not when it's distributed. So you don't have the ability, again, to gatekeep your profits, which we'll talk about next with the corporation. And then there are disposing of the partnership interest. Everything looks through to the partner still. So there could be withholding taxes in there as well. And so a little more complex structure. It kind of has to be the right situation. But one of the benefits to that is that the US and Canada would view the taxation of that similarly. So I probably didn't mention that, and I probably should have a few slides ago with regards to the tax filings for companies that have permanent establishments. In this situation with limited partnerships or the other, the tax that's being paid in the US is creditable. So you're not paying double tax if you're operating through a permanent establishment here. You're not paying double tax if you're being taxed through a limited partnership. You're paying tax to the US first where you're generating the income, but it would be available to you in Canada as a foreign tax credit. So it would not be a double tax situation. So in most cases, it would be still tax efficient. You still have to work out whether the tax rates here for some reason might be higher in a specific situation than it would be in Canada, but tends not to be the case, but would not be a double tax situation. And the most common entity that we get to is a corporate entity, a corporation. I'm not going to really get into where that should be formed today in terms of states that may be dictated based on your business and where you might be. But it's favored by outside investors. It's a lot easier to add U.S. investors. You know, we see that quite often, right? If you're trying to raise capital and things like that, you want to have a U.S. corporation. And then there's great tax implications to it. There's a lot we can do with, and we're going to get to that in a little bit later slides. You don't have to worry about the branch profits tax, so you can decide when the taxes are getting paid back to Canada. You can gatekeep those profits. You can use that as a potential tax planning mechanism to defer some tax. You don't have to worry about tax filings for the owners personally. And like I said, there's more repatriation strategies available, which we'll get to on a different slide, one of which is the intercompany debt. And so this organizational chart is something that we see quite often, whereas you have a Canadian residence. Again, we, obviously want to understand who are the investors, right? If you're Canadian, how are you taxed? If you're Canadian, but you have multiple either dual citizenships, we just have to understand for tax purposes, are you a Canadian resident? That's pretty important. So oftentimes we'll have that through a Canadian holding company. And then again, the Canadian holding company would operate as a branch, which is on the left, which would just be again a division, the corporation, or potential partnership. And so in the corporate structure, and that's what we're kind of illustrating here, and that's what this slide is more geared towards. That second layer of tax, we mentioned it was that 5% branch profits tax. Under the tax treaty, we want to hold it under a Canadian corporation because it gets 5% withholding tax on the dividends that you eventually pay to the holding company, ultimately the Canadian tax residents. The 5% is the cost of doing business. It's generally not available for a tax credit in Canada, but again, you're paying 21% on your profits federally. We'll talk about the state when Tom gets to that part of the presentation. And then after that, when you bring the earnings back, you've got 79 cents for every dollar that you make left after that. To the extent you're sending that back, you're going to pay a 5% toll charge to bring it back to Canada. Now, in the individual ownership situation, you would, under the tax treaty, pay 15% instead of the 5%. But it also opens you up for potential estate tax issues. If something were to happen to you, we'd be looking at the assets that you have, and you'd have U.S. assets, so you would need to potentially file a U.S. estate tax return and potentially pay some U.S. estate tax depending on kind of the ratio between your U.S. assets and your worldwide assets, with some relief available through the tax treaty. And before we move on to the next slide, the one thing I want to mention here is, at this point in time, we're talking about this kind of structure. this is where we really have a discussion with you about kind of your short-term and your long-term goals. Where do you see your business going? And very importantly, do you see yourself moving here to the US? Sometimes formation of the US business is really the first step in a Canadian resident's plan to eventually move to the US. And so that, usually if that's something that that is known up front, then we want to plan around that, and maybe we will go with a less top-down approach structure to hold your business, knowing that we would probably want to unwind that once you move down here. So, usually that's one of the things that I'm starting to lead with when we're talking to companies that are looking to move down here is kind of those mid-range goals, so that we can effectively structure your holdings. And so this is probably another very important slide: repatriation of profits, transfer pricing. So transfer pricing is when we're talking about related party transactions between two commonly controlled entities. So we're always talking about arm's length for those transactions, because you have two different countries, two different taxing agencies, the IRS and CRA, that are both looking at a transaction. They want to make sure that the right amount of profit is ending up in their country and subject to their tax. So really that is derived by looking at arm's length and what you would pay a third party to do, whatever the case may be, whatever it is. If we're using it in the context of debt, which is a good planning mechanism, and we're choosing the interest rate, well, what would that U.S. business go to U.S. bank, and what type of interest rate would they be charged on a potential loan? The IRS does not believe in tax-free loans, interest-free loans. Excuse me. But at the same time, we can't also probably choose a 20% rate of interest to be charged on a loan as well. But these are strategies that we can use to get money back to the home country, in this case being Canada. Management fees are pretty common, right? So to the extent that operations in the U.S. are being supported by Canadian back office, whether it be management, accounting, sales, any types of those costs that are being borne by the Canadian company that really in fact benefit the U.S. company can be charged in the form of a management fee. That would be invoiced regularly between the two entities. And the nice thing about the management fee is that it is there is no withholding tax under the tax rate. It's a deduction for you in the U.S. It's income to you in Canada. But at the same time, no 5% charge to pay as you would on a dividend. Now you can't just run loose with this and just decide to charge whatever you want year over year. 1 year it's $1 million, the next year it's $50,000. It really has to match up the facts and circumstances of what services and what roles the parent company is playing for the U.S. company. And it can change over time as the U.S. company becomes more mature. You may have less of a management fee, but depending on how your business is operating and what the roles and responsibilities of each company are, then you really just have to follow that accordingly. Intercompany debt is another, again, 0% rate of withholding on interest between the two companies, or between the companies. So another way to get your monies back to Canada on a less tax rate that's less than a dividend. Again, we mentioned dividends, and again, the sale of products. So that's something, again, that we can look at the transfer pricing issue, but we have to figure out, again, if you're selling a product between the two companies, what is the pricing going to be for that, and what would you pay a third party to do those same things? And then finally, because I'm probably over my time, business considerations, payroll taxes, HR, workers' comp, unemployment. And these are all things that the U.S. companies have to deal with. They're probably different than what your experience is in Canada, and as Tom is going to talk about in a moment. Nothing here is harmonized. So with that, I will turn over to Tom to talk about state income taxes.
Thanks, David. I appreciate it. The funny thing that we like to say when we're talking to Canadian and other foreign businesses looking to start doing operations or selling more in the U.S., we like to tell them it's like dealing with 51 different countries. You have the federal government, the United States, and then each state is like its own country in some ways, with different rules and regulations and whatnot. So the first thing I always really like to tell folks is that inbound businesses, a lot of times are advised by attorneys or accountants, say, oh, you have treaty protection, you have treaty protection. And David did state that you do have treaty protection for your business regarding US federal income tax. Those treaty protections do not extend to the 50 different states. They are not bound to follow permanent establishment rules for any foreign companies that are doing business within their borders. So that is something right off the top that, well, you may have one set of circumstances or rules to follow for the federal government in the US, the states may still require you to make filings. And this is a wide range of filings. It could be sales and use tax, which we're going to talk about, state income tax and gross receipts. We have property payroll taxes, depending on the state and your business activities. So there's a lot of different taxes in a lot of different jurisdictions that you do have to consider when you move down here. Well, there is some protection from that. The states can't tax everybody willy-nilly. There are some rules regarding who they can tax, and that's kind of governed by a concept we refer to as nexus. Nexus really is a minimum link or connection that your business must have with the state in order for that state to tax you. So without that link or connection, a state can't assume its jurisdiction over your business and impose taxes on you. Unfortunately, which you're going to hear a lot of, there is no uniform standard or threshold when it comes to really anything when you're dealing with the states. States can impose nexus based on different standards, which we'll learn about: physical presence, economic presence, and then an extension of that for income tax purposes, factor presence. So we're going to talk a little bit about those nexus standards. First off, talk about sales and use tax. That's really what I focus my practice in, is helping clients with their sales and use tax concerns, throughout the United States. So prior to 2018, sales tax was kind of limited in scope. If your business didn't have physical presence in a state, really didn't need to worry about sales tax. So if you didn't have a salesperson, or you didn't have a facility or warehouse that you were renting or owning, or inventory, located somewhere in a state, you really didn't have to worry about whether or not you needed to collect sales tax. Well, obviously the states down here were kind of frustrated about this. With the advent of the internet and the growth of the e-commerce in the 2000s, state tax coffers were kind of, I wouldn't want to say drying up, because they're never drying up, but they were losing money, from sales at brick and mortar stores, whether it was a clothing store, a bookstore, anything like that, to online retailers. And in many or most cases, those online retailers didn't charge tax because they did not have physical presence in a whole host of states. Maybe they had it in one state, like Amazon, for example. Way back when, Amazon had nexus in Washington State, and they didn't really charge sales tax anywhere else. I mean, I remember when I was buying stuff, I would go to the online retailer that didn't charge me any sales tax. So states were losing their revenue, and they were looking for ways to kind of expand nexus for sales and use tax purposes. So lo and behold, after a long series of new laws and regulations and court cases in different states, one state, South Dakota, imposed what we called economic nexus for sales and use tax purposes. They stated that, hey, if you're a business that makes $100,000 of sales in our state, or you make over 200 sales transactions with resident customers in our state, you have nexus for sales tax and need to register and collect. Well, they went after big online retailers, including Wayfair, the home goods online seller. So in 2018, they imposed this nexus threshold. There was a state court challenge in South Dakota that kind of elevated this directly to the Supreme Court of the United States. And the Supreme Court essentially said, well, you know what, we agree with the states. You know, physical presence has really never been right as a final straw or final say for nexus. And this economic nexus standard, yeah, that works. You know, if you're doing this standard and it makes, you know, sense, you can't go back and impose it on prior years. But if you look forward and you have this dollar threshold along with this sales transaction threshold, you know, the court blessed it. It said, states, go ahead and do what you want to do. And boy, did they ever. The states kind of went crazy over the next few years from 2018 to 2023, imposing these economic nexus thresholds for sales tax purposes. So you can see by this map here that, you know, the most common threshold these days is $100,000 of sales. The states like South Dakota, who originally had $100,000 or 200 transactions, a lot of them are really releasing or getting away from that 200 transaction threshold because they're finding they're bringing in a lot of small businesses and not a lot of tax revenue, and administratively it's difficult for the state tax authorities to kind of keep up with that. Obviously the dark shaded colors here with New York, California, Texas have a much higher economic nexus threshold, and that makes sense. Those are big states, a lot of population. You know, I always like to say $100,000 of sales in South Dakota isn't by close to being $100,000 of sales in California. So the states have adjusted their, you know, over the years, but you have to be very cognizant of these thresholds and whether or not your business is exceeding them for sales tax purposes. And again, I always said uniformity is not, you know, a principle we like to follow here in the US. So when it comes to these dollar thresholds, when it comes to when these thresholds were effective, like I said, some started in 18. The last one was January 1st, 2023 with Missouri. They're all over the place. And you really need to kind of look back to be able to see, okay, when did the threshold start? What were my sales? Because most of the cases, you have to look at a measurement period, you know, the prior year, current year, or prior 12 months to determine if you've exceeded the nexus threshold. You know, additionally, the types of transactions is a big issue. Some states are imposing these thresholds based on your gross sales, so everything. Some states are saying, well, just retail sales, which would mean all your sales except sales for resale, sales that you're selling to a distributor or to a third party for resale. Some states will say taxable sales. So the thresholds are kind of all over the place, and that's something we monitor for a lot of our clients, you know, on like a quarterly basis to see, hey, are you exceeding the thresholds? Because in a lot of cases, some states say once you hit that threshold, you may have to register on the next transaction or within 30 days. So we really need to take close watch on it. And again, just some other notes about the sales tax in the US. We all have, each state has different rules and regulations regarding the taxation of goods, services. We have over 13,000 sales tax jurisdictions here. Luckily, most states allow you to file your state and local jurisdictions on one return. However, we do have some localities in the states of Alabama, Louisiana, Alaska, Colorado, that collect and administer their own sales tax, which means you have to file a separate return with like the city of Denver or the city of Boulder or one of the parishes in Louisiana. And typically we do sales tax on a monthly, quarterly, or an annual basis, depending on the dollar amount of your sales. The frequency, filing frequencies determine once you kind of hit a certain threshold of sales. One note I always like to make, whether I'm talking to any of my clients or otherwise, if you are selling to customers for resale, you're selling to a distributor or a third party who's going to resell, or it's a ingredient or component of a product you're selling to a manufacturer, whether or not you're registered or not, I always think it's best practice to collect an exemption certificate or a resale certificate from that customer. This documents the non-taxable nature of your sale, and it's something you should keep on file in case a state ever comes to you with a nexus questionnaire or other inquiry about the nature of your business activities in their state. So that's all for sales tax. I want to jump over and talk about some income tax, because that's just as confusing as sales and use. Income tax, we have a few different standards for nexus. We have a physical presence nexus standard, which any type of property, payroll in a state, and depends on the type of payroll. If you just have salespeople, which we'll talk about in a few minutes, that may not create nexus for income tax purposes. But these days, we see a lot of companies with a lot of remote workers, whether it's marketing, IT, maybe an accounting person, they're living in different states from where the business is based. And those people who aren't doing sales activities may create a nexus for income tax purposes. So physical presence, like I said, pretty standard, pretty self-evident in most cases. Economic nexus is a concept for income tax we reached long before we did for sales tax. This was like in the early 1990s where economic nexus kind of came up for income tax purposes. And really, I don't talk much about economic nexus because while a lot of states have maybe, applied tests or, expressly adopted laws in their statute, it's very limited in its application. Basically, if you're a business, they're kind of determining whether or not you have economic nexus about whether your ability to make a profit from maintaining a market or directing your market activities in a state. And this is limited in a lot of cases to holding companies that license intangible assets in different jurisdictions, financial institutions generating income from credit cards or loans. We really don't see much economic nexus. It's not very well defined and very limited in application. However, in the last few years, we've seen an extension of economic nexus where states are trying to tie your activity, your sales to a specific dollar amount in a state. And we call this factor presence nexus. There are a number of states out there now that would consider you doing business in their state if you hit a certain dollar threshold of property, payroll, or sales over a specific period. Now, I don't really focus with a lot of Canadian and foreign entities on the property or the payroll, because you're likely not going to have that much of that down here. We kind of focus on the sales dollar thresholds. And there are a number of states like California and Michigan and New Jersey, Hawaii, and Washington are three states that tie their factor presence income tax nexus to their sales tax threshold. So in each of these cases, it's $100,000. So $100,000 would give you nexus in New Jersey for both sales tax and their income tax. So that's something a lot of businesses really need to be cognizant of these days. So again, on you know, we like to say there are protections, right? You know, we talked about nexus in the states, can't go crazy taxing everybody. Well, the federal government realized way back in the last century, in 1959, that, you know, the states are going to do this. And they created the Interstate Income Act of 1959, what we refer to as Public Law 86272. And this is a really important law for net income tax purposes, because the federal government can issue these laws or acts that really supersede any state level of authority due to the supremacy clause in the US. So if your business simply solicits orders for tangible personal property in a state, and you send that order outside the state for approval, and you ship that product from inventory located outside the state, then typically a state can't impose its income tax nexus on you. So again, though, it's very limited. It's limited to tangible personal property. You know, so no service, can't be soliciting for service, can't be soliciting for digital or intangible property. You have to send that order outside the state for approval, which, you know, these days is kind of gray area with how you're doing that. The inventory has to come from outside that state. In some cases, the protection may not be afforded to a foreign seller, but that's really on a state-by-state basis. You would have to look at and evaluate the facts and circumstances for that. But that is kind of generated and offered a lot of different protections. And I could talk about PL 86272 for an hour and what is considered a protected activity versus a non-protected activity. So if all you're doing in a state is soliciting, you're probably good. But like I said earlier, if you have remote workers, you have a marketing person, an IT person, a development person, that's going beyond solicitation of sales, and that pretty much generates an income tax nexus in a state. And we see that a lot more as companies are more diverse and hire remote workers. They're not, you know, sometimes centrally working in an office, especially if it's, you know, something like that. So there are some what we would call traps for PL 86272. I mean, the states are very clever and very smart. And, you know, I said PL 86272 only provides protection for net income taxes. So how do you get around that? Well, you have what we call franchise taxes or minimum taxes that are maybe on alternative basis, you know, capital, you know, your sales dollar amount, whatever. So you have to be very, very careful with these taxes. California has an $800 fixed minimum tax if you hit a certain level of sales on their factor presence. And then you have other, New Jersey, I refer to New Jersey a lot because New Jersey's been big lately because they made changes last year. New Jersey also has a minimum tax. I mean, you may have $100,000 of sales and you may not be subject to their income tax, but you're subject to their minimum tax that needs to be filed every year. We have states like Ohio, Texas, and Washington that have gross receipts taxes, not based on your net income, they're based on your top line sales. So those are all issues you need to concern yourselves with, because while these taxes may be minimal, if you don't file, don't remit the tax over a number of years, you tack on interest, tack on penalties, those amounts are going to add up. If you never file, there's no statute of limitations that ever gets to start running. So that state's got to be able to go back as far as they ever want. So, you know, just everything to be very careful about when you do business in the US, and just some other issues. You know, we talked about registration. You know, in many cases, you may need to register to do business or authorize yourselves to do business in the state with the Secretary of State, more of a legal filing as opposed to a tax registration, which maybe need to be done too. Talked about the gross receipts taxes, you know, payroll taxes. If you have US employees or you have, down here, you're gonna have to register them for employee withholding, unemployment taxes and everything that goes along with that, through a US payroll company, or taxes on real property. Many states, in the South and the West have personal property taxes as well on assets and inventory in some cases. And then there's the local governments, business licensing, registration fees, whatnot. There's just a gambit of taxes in the US that not only do domestic American businesses have to concern themselves with, but also foreign sellers. So I think at this point, it's going to take us to the end of the presentation, Carolyn.
All right, thank you guys. If anybody has any questions they want to put in, feel free to put that in the question section. We have a couple coming in, but I do want to pop over. I do have one last poll for everybody today, and our experts are reviewing the questions that are already submitted. So just kind of want to see where you're at based on what you learned today. How are you feeling? Think you got this under control? Do you have some homework to do? Are you in big trouble? Just kind of want to see where you're at. Looks like most people are pretty good and have a little bit of homework to do. It's a lot of information we gave you today, so I'm sure it'll take some time to digest and double check how you're doing things. Looks like most people have responded, and again, about 50% of you are looking good. Just share it so you can see where you fall in. Definitely some people have some homework to do. So that's pretty good. So guys, I just kind of want to turn it over to you, and it looks like there were some questions. So David, do you want to?
Yeah, read those. Read a couple of these off. So the first one is, if I sell to a distributor, how do I know where they are delivering it?
I mean, it really doesn't matter where the distributor is delivering it. It's where you're shipping it to. Your sales with the distributor. So if the distributor asks you to ship it to Massachusetts, for example, that's where you would want to concern yourselves with getting maybe a resale certificate from the state of Massachusetts. I don't want to get into drop shipments. That would be a whole other talk that we could probably talk about for an hour, but there are some complications if someone's asking you to drop ship on their behalf.
Second one here, if I am covered through USMCA, do I have to worry about any of this? So USMCA, which I don't even know what the status of it is right now, but that is all customs based. So everything in today's presentation, there's no intersection between USMCA and the U.S.-Canada tax treaty. There certainly isn't between state tax nexus and any of the state issues. So USMCA, unfortunately, really wouldn't apply to anything that we touched on today.
Can you explain the definition of tangible personal property? If we sell an item that goes direct to end consumer and selling same product to a wholesaler, is the product sold to a wholesale not considered TPP? No, I mean, in both instances, it would be considered tangible personal property. I mean, generally everything is tangible personal property, unless you're performing a service or it's intangible. There are just two different types of sales. A sale to an end consumer is a direct sale that you would potentially be responsible for charging sales tax on, while a sale to a wholesaler, we would consider a resale, a sale for resale. And we only tax at the end, the last stage to the end user. So you would not have to tax that sale to the distributor, but you'd want to collect documentation a resale certificate showing that that sale is non-taxable.
So looks like the next one, is there a resale certificate in Canada? We have a location in Quebec. We produce a lot of materials incorporated in the final product.
No, because I think with the GST, everything's taxed at
Yeah, so
different stages.
I take it to mean you're buying things there, you're getting charged GST, HST. And we can take this offline, your question, but I believe that you would have to possibly register in Canada and file like a refund type of claim with the Canadian government or Quebec in this case to try to get a refund of those taxes for that product that is leaving the country.
I got the next one. I sell mostly on Amazon and Etsy, who collect the taxes and remit sales taxes. If I sell my own website, when the threshold starts, all sales are the ones I collect taxes on my website. That's a good question, and really one of the finer points we couldn't really get into is that the states have different rules for what we call a marketplace facilitator, like Amazon or eBay, or in many cases even like a Walmart, or even Wayfair these days. But those cases, those big facilitators have to collect and remit sales tax on sales that a marketplace seller, such as yourself, is selling on their website or on their platform. But if you have your own website that you're selling from too, so you're a multiple channel seller, then you may need to collect sales tax on the sales from your website. It just depends on the dollar amount. In some cases, a state would not consider your marketplace sales for counting your threshold, like the $100,000. In some cases, they will. It's kind of a state by state basis. So that's something, if you have questions on, I'd be happy to talk to you offline.
The next question is, I need to set up a payroll in the US, state registration asks for a responsible party with a social security number. No Canadian individual has a social, so how would you accomplish this? We generally, it just takes a little bit longer. You have to possibly, instead of filing an online application, you may have to file a paper application to do that. Unfortunately, it's you can't just, we have what's called an ITIN, or individual taxpayer identification number, that you can obtain, or a non-resident can obtain. But in order to, you have to have a reason to apply for that. And unfortunately, having your facts and circumstances, with this facts and circumstances, wouldn't qualify necessarily on its own to have to get one. So you can get a registration. The same thing happens to us when we register you for sales tax. The process takes a little bit longer when you have, if you don't have somebody at your company that has the US tax identification number.
I mean, some states care, some states say, oh no, we got to file a paper return and we need to see your Canadian ID numbers and whatnot.
Yeah, just a few more hoops to jump through. So one final question, because I know we're well over probably now time. If we are contracting with a third party to install our product, what do I need to do if we are, or do I need to do anything if we're below $100,000 of sales into the state?
If you're contracting with a third party, then that means you're going to have nexus typically by the presence of those people in that state. So this is something probably I could have said earlier too, when we talked about economic nexus. You know, that's the latest and the greatest strategy for states, but physical presence still exists and trumps economic nexus. That's probably not the best way to say it. But if you have any physical presence in a state, the threshold kind of goes out the window. And if you're contracting with a third party, that's more than likely going to give you physical presence in a state. And you would have some filing requirements for income tax and sales tax as well.
Yeah, I mean, I have a number of clients. I have a number of clients that we file federal treaty-based returns. We're covered in the treaty, right? And then something is happening in the States. They're using a third party to do installation. They're using a third party to do commissioning or training or some type of activity, or they're doing it themselves here, but they don't give rise to that permanent establishment. So we file an IRS tax return with them, claim the treaty, and then we file in the states that they might be doing, having nexus in, and they pay some state taxes. Again, that's available for tax credit in Canada. So, but certainly any type of third party, anything that your company is charging for that is done by a third party just on your behalf is still going to create the nexus for you.
All right, a lot of great questions, a lot of great information. Thank you for everybody joining us today. Thank you, Tom and David, for being our experts and providing all this information. If anybody has any questions, feel free to reach out directly or again in the follow-up surveys that we'll be sending you. And just as a reminder, I will send everybody a link to the recorded presentation and the PowerPoint presentation if you want to watch it again or again share it with somebody else. We will be having more on this cross-border topic and also state and local tax over the next couple months. So watch your emails for our upcoming webinars. Thank you. Have a good day, everyone.